I think so, absolutely. It's going to start competing with sovereign bonds, and particularly with the US dollar, of course, because for various reasons, many foreign governments don't want or are less keen, let's say, on US bonds than they were. So, yeah, I think gold is the ideal asset. I'm not overly concerned about, it's to be expected. It's to be expected, and I think we've mentioned this before, that the buying from central banks would slow the pace of growth. It's been the rise from really 2020, 2022 particularly, and then, has been so dramatic. But if you look at the buying for the first quarter, we only have the first quarter numbers, and then we have April's numbers. It's still well above where it was in the teens and the O's, whatever you call them.
Gold is increasingly competing with sovereign bonds and the US dollar, as many foreign governments are less inclined to hold US debt. Despite a slowdown in central bank gold buying, it's expected after the sharp rise between 2020 and 2022. Current buying levels remain significantly higher than in the 2000s and 2010s, showing strong ongoing demand. The breakdown of the historical correlation between U.S. Treasury yields and the dollar indicates a shift in investor behavior, with gold emerging as a more attractive option amid uncertainties. Rising yields on long-dated U.S. Treasuries and a declining dollar are raising concerns about the United States' fiscal stability. Analysts warn of a potential sell America trend, with investors seeking alternatives to U.S. assets. Adrian highlights that the gold's long-term outlook remains strong due to fundamental drivers, such as central banks diversifying away from the dollar amid geopolitical tensions and currency risks, especially with China's increased gold buying to protect its assets. Central banks, particularly in emerging markets, have been increasing their gold reserves as part of a strategy to diversify away from the US dollar. This trend is expected to continue, further supporting gold prices. Goldman Sachs forecasts that gold prices could reach $3,700 per ounce by the end of 2025. Driven by strong central bank demand and potential interest rate cuts by the Federal Reserve, investors are also turning to gold as a hedge against economic uncertainties. Goldman Sachs analysts suggest that gold can help long-term investors hedge against financial risks, mainly as bonds and stocks often sell off in tandem this year. Recent news indicates that the U.S. faces a critical debt ceiling deadline by mid-July, with Treasury Secretary Janet Yellen warning of a possible default without congressional action. The current debt limit stands at $36.1 trillion, and the Treasury is using temporary measures to avoid breaching it. President Trump's administration supports a $5 trillion tax and spending bill, the One Big Beautiful Bill Act, to raise the ceiling. However, critics, such as Elon Musk, oppose it, citing concerns over increased national debt and social impacts. The Senate is set to vote on the bill soon, with a July 4th deadline that will determine whether a default is averted. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
There's certainly an awful lot going on. But as I look around the world at the monetary economic situation as well as the geopolitical situation, but particularly the monetary situation, it's difficult to think of a scenario that's really gold negative, fundamentally and long-term gold negative.
Yeah.
Fundamentally, as we know, for the last 3 years, fundamentally, the gold price has been driven by central banks, diversifying their assets in the face of dollar weaponization. That's been the fundamental driver. And then you've had Chinese investors in the last maybe 12 months, 10 months, who've really ramped up their buying in the face of concern about a yuan devaluation and a weakening Chinese economy, and concern about the banking system. So they're not putting money in the bank. They're protecting their assets by buying gold. Neither of these two factors, which have been the main factors driving gold for the last 3 years, are really related to trade, Trump, US, and they're not really related to the macroeconomic environment. They're related to very specific things. I think more recently we've seen more buying come in relating to the fiscal issues. It's not just the US. The US is the US is the most serious, because it's the reserve currency. But many other countries in the world have fiscal problems as bad as or worse than the US. So, people are beginning to react to that, and how do we get out of this situation? So I think things like, and I don't mean to downplay it, but things like Israel and Gaza and the threat of Iran, let's face it, if you look at the last 10 years, this is an astonishing fact. Yeah. Gold has been the least volatile asset of any. The stock market, the bond market, certainly crypto, foreign stock markets, currencies, the dollar even. They've all been more volatile than gold. And so what you want as a reserve asset and what you want as a liquid asset for banks is a non-volatile asset. So, no, gold to me is the ideal asset for that function. That's one of the most compelling factors coming up. Mm-hmm. You know, if the US has here's what I think is going to happen, although here's what I think could happen. The US, we all know, is having difficulty funding its deficit, and it's doing it increasingly at the short end. I don't criticize Besson for that because he was handed basically an empty Treasury. And in fact, Janet Yellen on a Friday night interview on January the 19th or whatever, before Trump was sworn in on the Monday, said, I mean, I can't remember the quote exactly, but it was basically, there's no more money. Oh, that's right. She said the Treasury is likely to default by Tuesday. Thank you very much.
Yeah, good luck.
And so I don't criticize Besant for this. He has to fund at the short end. Because to fund at the long end would mean significantly higher rates at this point. People would demand higher rates. But we've got the debt ceiling issue, which is a whole different subject, but we've got the debt issue, and everybody, including Besant, including the Treasury, say that by the end of summer, the US is going to run out of money. And so I think if that comes to a head, the US is that the Fed is going to institute QE again. Now, that's not an original idea for me.
September?
Although I claim it I think by the end of summer, September, they're going to be QE again. They may not call it QE, but we'll have QE. And I think QE is much more likely than dramatic interest rate cuts, frankly. Because the concern right now is not the job market, which would mean you want to do rate cuts. The concern right now is the funding of the federal government, which means QE. Rate cuts don't do much for funding the U.S. government.
Adrian Day suggests that the current macroeconomic environment hasn't favored gold because the economy appears strong, inflation is low, interest rates are high, and the dollar is strong. Conditions that usually discourage gold buying. However, cracks are now showing. The U.S. economy is slowing, retail sales rely heavily on credit card debt, and many new jobs are part-time or government roles. As stock market leaders begin to falter, investors may start seeking alternatives, such as European or emerging markets, small cap, value, or commodity stocks, especially gold stocks. Additionally, a significant portion, approximately 20% of U.S. stock market inflows originates from overseas. If foreign investors withdraw due to political tensions or a weakening dollar, it could have a substantial impact on the market and 401k investments. Senior mining stocks still offer good value despite recent gains of around 44 to 45% over the past year. Their valuations remain low compared to historical levels. Barrick, for example, is trading near its lowest price-to-NAV levels ever despite ongoing political risks. Agnico Eagle, AG, is also trading in the lowest 20% of its 40-year price history, with strong cash flow and high profit margins, making these stocks attractive investment opportunities.
I think the big issue is that we talked earlier about the central banks and the Chinese consumers who are buying for particular reasons, but what they're not buying for is because of the macroeconomic environment, right? So typically, when the economy is seemingly strong, inflation is low, interest rates are high, the dollar is strong, that's not a conducive environment for buying gold. And so for ordinary retail people, I don't mean as a defensive asset, but an ordinary investor, that's not the environment which is attractive to gold. And that's really been the environment that we've had for the last several years. Yes, we had the weak GDP numbers, but there were all sorts of excuses about that, and it was just brushed off. Now, when you come to the stocks, you add another factor to that. When the S&P and the TSX are going up month after month after month, you don't look for other things to invest in. So what I suspect, and we're beginning to see cracks in the economy right now, right? I mean, it's pretty clear in the US that the economy's slowing, retail sales are only being held up by high credit card debt, so that's unsustainable. Jobless in the US, new jobs creation numbers are high, but literally a majority of the new jobs created are either government or part-time, so that's not healthy. So we're beginning to see these cracks in the economy. Interest rates, they're going to have to cut them at some point, and the dollar is, let's say, volatile.
Yeah, to say the least.
So we're beginning to see the macroeconomic environment for gold turn more positive. And I suspect what we're going to see when the stock market, when the erstwhile leaders start to falter, they don't have to collapse, just falter, people are going to start looking elsewhere. We saw this in January, February, when Nvidia and Microsoft and Tesla had their big drops, and money started flowing into European equities. So I think we're going to start seeing people look for other places to put their money. It might be European equities or global markets, it might be emerging markets, it might be small cap, it might be value, which is grossly underperformed, right. Defensive stocks, income stocks. But one of the areas which has underperformed where people will look are commodity stocks, and particularly gold stocks. So I think that's what we're going to see when the macroeconomic environment shifts and the stock market shifts. And one last thing about the stock market, if I may. One thing that I don't think has been focused on enough is the amount of money from overseas that has been pouring into the US stock market month after month after month in the equivalent of the 401ks, just automatic, passive investing into the US stock market. Now, when President Trump, and I had to say the word, I'm sorry, when President Trump, when the administration, in effect, makes it clear to foreigners, we really don't want your money, the dollar's going to get weaker, we don't really care about the stock market, and we don't really like you anyway, that money at some point is going to stop flowing into the US. I don't know if you say that in Canada, but anyway.
They do.
Okay. But the valuations are still low. You look at Barrick obviously has its own problems, but Barrick's trading in its lowest decile of price to NAV in its entire history. And it's had political risk for quite a long time. It's had other risks for quite a long time. Agnico, obviously, the la creme de la creme, is trading in the lowest 20 percentile, if that's a word, the lowest 20% of its 40-year history in terms of price to cash flow.
Despite recent market volatility and economic challenges, gold and senior mining stocks remain strong and attractive investment options due to their stability, low valuations, and fundamental demand drivers. With increasing concerns about government debt, geopolitical risks, and shifting investor behavior, these assets offer a valuable hedge and potential growth opportunity in an uncertain environment. How might rising geopolitical tensions further influence gold demand in the coming years? What impact could a slowdown in foreign investment have on U.S. stock markets and retirement portfolios? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up, and remember to subscribe to stay updated.